Well, when you look at the headlines these days, there's certainly a lot of uncertainty. Tariffs is a great example of that. But when you actually look at the stock market charts, after a very positive year for both Canada and the U.S. in the stock market, we have continued to see momentum for equities. It's more of a mixed session today, yes, but what is the momentum story going forward going to look like? Jeff Schulze is head of economic and market strategy at ClearBridge Investments and joins us now. Jeff, good to see you. Let's just talk a little bit more about your assessment of the mood in the markets these days.
Well, the markets are clearly cheering the fact that inflation doesn't appear to be problematic in the U.S. After a relatively soft December CPI release, the internals were favorable. Core goods, yes, was positive, but it was really an automobile story that's still being propped up because of the hurricanes that you saw in October in the U.S. Inflation, shelter inflation continues to move lower. OER, which is the bigger chunk of shelter inflation, saw 6 out of the last 7 months lowest monthly releases since 2021. And yes, Supercore was positive, but not problematic for the Fed. So this comes on the back of stronger economic data, and it really creates a Goldilocks situation for the markets and earnings expectations that clearly are attainable for 2025. So with the Fed not going to be problematic, markets are cheering that and continuing to move higher.
And, you know, whenever we talk about tariffs, we talk a lot about them, certainly here in Canada right now, as you can imagine. People try to figure out mathematically what the inflationary effect from that could be. I got to tell you, we get to talk to a lot of different people. There is a chorus of people who don't see the inflationary impact being as meaningful as some might fear. Where do you weigh in on that?
Well, if 25% tariffs go into effect for all goods from Canada and Mexico, that's going to increase U.S. core PCE by about 1%. Again, assuming a 75% pass through to the consumer. But ultimately, I think that this is more smoke than fire. If President Trump really did want to institute tariffs on our closest trading partners, he wouldn't have announced it so far in advance and given a lot of time for negotiations to come to fruition. So I know that February 1st has been thrown out there as a date for potential escalation, but I think it's likely going to get pushed out a couple of months. Concessions will be made from both Canada and Mexico, and although some tariffs may move into place, I don't think a universal tariff will. I think it may be much more targeted on individual sectors. But should that blanket tariff go into effect, it's going to be disruptive not only to the Canadian economy, but the U.S. economy as well. And I don't think the administration really wants that.
I also want to just talk to you about sector flows, where money is going. Everybody who was watching the inauguration this week saw all those big tech CEOs gathered in Washington. A lot of the tech stocks are finding momentum. Here in Canada, I mentioned we've had a pretty nice winning streak recently. The best performing group, though, is tech. It's not as big a component of the Canadian market, but you know, all the AI excitement seems to be influencing stocks here again. There's a look at the NASDAQ 100. So when you look at different pockets of the market, what do you see right now?
Well, Taiwan Semiconductor released their earnings, and it was a blockbuster release, and guidance was extremely strong, which does show that the AI CapEx cycle is still very much in place. And I think that has obviously been a tailwind to that area of the markets over the last week. But what I find is really interesting is if you look back in the last month in the S&P 500, the top sectors on a relative basis are energy, materials, industrials, and financials, which are clearly more cyclically oriented companies. And they've been relative laggards over the last couple of years. And what we anticipate for 2025 is that after several years of very lackluster growth from most of U.S. equities, earnings delivery is going to be much more broader, and that's going to benefit these areas that have underperformed, because when earnings growth is very scarce, investors move into these rock-solid companies that can grow, which has been tech and more specifically the Magnificent Seven. But when earnings growth is abundant, which is what we're anticipating, investors will move into these areas where earnings growth is a lot cheaper. So we've started to see it, and even though tech has done well over the last week or two, I'm anticipating that these more cyclical sectors are going to be the ones of relative outperformance in the next 12 months.
And on that, just let me slice it a slightly different way. We have I don't know if it's a caveat, it's fact that the S&P had 2 back-to-back years of advances of more than 20%. And to your point, when you look at the best performing sectors in each of those years, it was largely technology companies. So what about the fact that we're coming off 2 very strong years for the S&P 500?
Well, a lot of investors think that just because you've had 2 good years of returns that you need to go back to the long-term average and you got to have a poor 3rd year. A good analogy for this is if I flipped a coin 5 times in a row and it came up heads every time, most people think that that 6th flip would be better than 50-50 of coming out tails. But the law of large numbers doesn't apply to small data sets, and the same is true for the market. So when you had 20+% total returns in the S&P 500 going back to 1950, and this has occurred 8 times, in year 3, which would be 2025, average return, believe it or not, is 12.3% with a positive hit rate of 75% of the time. So when it comes to market returns, an object in motion tends to stay in motion, and given the healthy economic backdrop that we're anticipating in the U.S., we think that we will continue to see positive returns here in this year.